Hello everyone. In this video, we'll discuss about two of the most widely used ratios that are being deployed by investors for valuing a particular stock or for screening a stock based on certain parameters. So the two ratios which we are going to discuss in this video are the P ratio, also called as price to earnings ratio, and a dividend yield ratio. So we'll discuss about these two particular ratios, and also we are also going to discuss about the dangers that are associated by just investing. If you are just going to invest by looking at these two parameters, so what are the different or what are the flaws that are associated with it if you are just going to invest by looking at these two particular ratios only. So all those things we are going to discuss in this particular video. So first we'll talk about a P ratio. What exactly a P ratio means is that you take a price or you take the current market price of that particular share in the numerator, and then you divide that particular thing by the earnings per share, which is in the denominator, and the result of that would be a P ratio. So alternatively, you can also define it by by dividing the market cap of a company, which is nothing but current market price into number of shares outstanding, and you divide that by the net profit of that particular company. So basically, both these things are same. In the first formula, we are talking, or we are arriving at a P ratio from a per share perspective, and in the second one, we are going to we are discussing from a entire organization perspective. So depending upon what you are taking in the denominator, which is EPS, based on that, you can also categorize this particular ratio in three different ways. The first one would be trailing P. Second one would be a current price to earnings ratio, and the third one would be a forward P. And the way you define it is that if you're taking trailing 12 months earnings per share, then you will have a trailing P. If you are taking EPS for the last financial year for a particular company, then you will arrive at the current price to earnings ratio. And if you are taking or you are extrapolating the earnings per share based on the growth prospects of that company, then you will have a forward P ratio. So depending upon how you take or how you define EPS in the denominator will give you I mean accordingly you will have three different P ratios. And the third point would be is that so company which usually which are cyclical in nature, or which have business which fluctuates with the as and when the economy grows, and there is a slowdown in the economy. So those businesses, an example of this would be, let's say, a cement sector, or maybe metals, the companies which are operating in metals, or a good example, better example would be like companies which operate in auto sector. So all these businesses are usually cyclical in nature, and so markets what markets do is they do not give much pricing to such, or markets do not view these stocks in a good way. I mean, so when I say good way, I mean the prices are not as high as as other sectors. And so similarly, what happens is these stocks usually have a lower in general, they have a low price to earnings ratio. And in contrast to that, companies which are usually which are operating, let's say companies which are operating in FMCG sector, for example. So companies which have a consistent free cash flow, or growing free cash flow. So those for I mean, to those companies, the markets usually give them a higher P ratio. So this is how usually the things happen in equity market, that markets do not like uncertainty in the earnings or growth prospects. So cyclical industries or cyclical sectors being their business model being in that way, they are usually given a lower P ratio. And companies which have a robust business model, or companies which usually operate in FMCG, where the products are being used in our daily life, so such companies have good consistent positive free cash flows, or maybe in some cases growing free cash flows. So markets award them with a higher price to earnings ratio. So that was the third point. And then so the problem with this particular P ratio, I mean, just investing by looking at a P of a particular stock, the problem is that, as Warren Buffett has clearly highlighted, that if you are just investing by using a P ratio, then it is an equivalent to driving a vehicle using a rear view mirror. So basically, what exactly is happening is you are taking decisions based on what has happened in the past, but then markets are everything about what's going to happen in future. So those who invest by looking at a low price to earnings will find that the markets have already incorporated the future earnings future lower earnings in the current price. So say for example, if a company has declared that their earnings are going to deteriorate in the next few quarters. So what happens is usually you will see a dip in the share price of that particular stock, and subsequently what will happen is that the price to earnings ratio of that particular stock will be on the lower side. Then to an amateur investor, what will happen is that this price to earnings lower P ratio stock will appear to be attractive, which is not the case, because what markets have done is they have already discounted the decline in the earnings in present, and that is the reason the P ratio of that particular stock is on the lower side, which might seem attractive, but then which is not the case. And this is exactly is the problem with using just P ratio as using only P ratio for investing. So this is one of the problems, or the drawbacks that we have. And usually such stocks, instead of appearing, so stocks which have single lower single digit lower P's, so they from an amateur investor perspective, they might seem quite reasonable or quite valuable in that case, but then usually such stocks turn out to be a value trap, and that too in equity markets in India. So if you just invest in stocks which have a lower P, you will find that instead of getting a good bargain, or getting a good value, this thing, like instead of having a good value bargain with that, you will find that on the other side, you will find that you might lose out on that particular stock. So that is one of the issues with the price to earnings ratio. And second is that in case of non-recurring earnings, so basically what is non-recurring earnings is the which are one-time earnings. So for example, if a company has sold its one of its subsidiaries, or maybe if a company is in divestment mode, so it is selling off its assets and all, so usually what will happen is for a temporary period or for a certain period, the earnings will be on a very higher side, so there will be an abnormal rise in the regular earnings. And since P ratio takes earnings per share into account, so you will find an abnormal increase in the earnings per share, and subsequently the P ratio would be on a very lower this thing, because the earnings part appears in the denominator, so your entire ratio will be on a very lower side. And again, to an amateur investor, it might appear that the company is very valuable, or maybe company is very cheap, but then the problem is that these sort of earnings are not recurring in nature. These are due to some special type of causes, or to say these are non-recurring earnings. So again, if you just invest by looking at a PE of that particular stock, then you are going to get hammered in the equity markets. And the third point, which I have not mentioned in this particular slide, is that since it takes EPS or earnings per share into account. Now we have seen and I have also mentioned about in many of my previous videos, that net profits or net earnings is something which can be easily manipulated by a particular company, by the way they take depreciation into account, or the amortization into account. So earnings is a number which can be speculated, or which can be manipulated by the a particular company. So that is the reason we focus on the free cash flow, that is the actual cash which is available to the shareholders or to the owners of a company. So if you just take earnings per se, but then it's also, say for example, a typical example would be like companies which operate in cyclical sectors. Like they might give a good, they might have a good earnings per se, but then since majority of the earnings again is reinvested back into the business for its equipment maintenance and plant maintenance, or if they want to do some sort of capex or something. So all those things, all those reinvestments back into the business does not get factored into the earnings, and that is a reason that price to earnings may not give you the clear picture of a particular regarding the valuation of a particular company. So that is a one of the that is few of the flaws that we have discussed. If you just take P into account for taking any investment decision from a value standpoint. And the last point is, and so basically this P ratio usually is used by people who want to see that which asset class is in which particular asset class they want to invest. So from a very macro perspective, it is helpful that let's say if let's say if a Nifty is Nifty is having a P ratio of, let's say, 25. I don't know exactly currently what is the ratio, but let's assume that if today Nifty 50 is having so all the 50 companies, when you add it up, and you arrive at a, P of that particular index, Nifty 50, then let's say if that I mean uh, if that P ratio of that particular Nifty is, let's say, 25, so inverse of that becomes your earnings yield, because inverse of that would be your earnings divided by price, which is nothing but what is your earnings yield. So let's say in this case, if a P is 25, then maybe the earnings yield would be the 4%. And then if you are getting let's say 6% in the bonds, so in the government securities like 10 years or 30 years, so if the current yield is, let's say, 6%, then again it becomes a decision that how you're going to allocate your money. So which asset class would you select for allocating your money? Because we know that equity markets have risk involved in that, because we don't know whether whatever amount of money we are investing, whether we are going to make a profit out of it or not. So there's a risk involved in the equity markets, whereas in the fixed income markets, which is like your bonds and all, so there the risk is very less. I mean, the risk is still there, but then as compared to equity market, the risk is very less, because that is the reason you are having a lower yields in that cases. But then if you so usually what investors do is they compare the yields of a particular asset. So in this case, if the Nifty has a P of 25, which means earning 0 to 4%, and if bond has, let's say, if the bond if the interest rates are such that the bond yields are 6%, then the people are going to compare whether does it make sense to invest in equity markets, or should I invest my money in bonds or other fixed income securities. So in that way, PE ratio is helpful from a very macro standpoint, and that is a call that usually all these big investors around the world they take. All these FIIs and these investors and all, they this is the decision they take. They always compare the yield in the equity markets vis-a-vis yield in the debt markets or in the fixed income securities. So that was about P ratio, and a very small example I have written. I mean, I have mentioned that how to calculate a P of a stock. So on the bottom left corner of this particular slide, that let's say if a company's EPS for the entire last year is rupees 1.6. So again, it is from a per share perspective. So EPS of 1.6, and let's say if the current market price is 32. So it is very simple that you can calculate P of that stock by dividing the current market price of that particular stock with the earnings per share for the last year. And then in this case we can see that it has a P of 20, and then you can compare it, but compare it with its peers, or maybe you can take as average sector P average of the particular sector, and then see whether the companies are companies trading at a higher multiple or a lower multiple. But then again, as I mentioned, it has its own flaws, the way P is being construed. So that is the reason we should be, we should not just focus clearly on P and take our investment decisions. So similar to PE ratio, we have also many investors focus on something called dividend yield. Now, before discussing again the flaws of dividend yield, we will first see what exactly do we mean by dividend yield. And so how do we calculate a dividend yield is of a particular stock is you take the dividend which has been given or which has been provided by a particular company, again dividend per share, and you divide that particular amount with the current market price of that particular share. So you will get a dividend yield on that particular stock. So second point is that high dividend yield stocks are usually preferred as they give extra returns in addition to price appreciation. So let's say if a dividend yield of a stock is 3%, so and in usual you expect let's say 15% returns from price appreciation. So in totality you will get a 15 plus 3, which is 18% returns from the investing in particular stock. So again, that's the reason most of the investors they prefer stocks which have a higher dividend yield. And companies usually what they do is they pay a part of net earnings or profit as dividend. So how can we calculate that how much percentage of earnings they is being declared as dividends is something that you can just go and see company's profit and loss statement, and from at the bottom of that it is being written that, let's say if a company's total profit is, for example, let's say 100 rupees, and then they have a or they have a payout ratio as 45%. So what it means is that out of 100 rupees, they have paid 45 rupees as dividends to its shareholders. So that is how these entire things play out. If I talk about point number four, that investing by just looking at a dividend yield can be detrimental, and it can again be a value trap. So again, just like a lower P, if you see that a stock has a higher dividend yield, it does not necessarily mean that it is a good value buy, because again, let's focus on how the formula is calculated. So let's see that dividend yield is nothing but the amount of dividend given by a company divided by the current market price. So if there is a company whose price has fallen massively because of any news, if there is any, if there is news that the company might post losses, or if there is any problem with the management of a company, so because of any negative thing, if assume that if the prices have fallen massively, then what will happen is the dividend yield would look very attractive, because again, if price is in the denominator, so if your denominator decreases, your entire ratio will increase. So to a new investor or an amateur investor, it might appear that the stock is very attractive from a dividend yield standpoint, but then that is not the case, because the dividend has not increased, but then the prices have fallen very massively. So that is the reason that you should again understand that how exactly things work out. And again, an important part of it is that investors must really do a thorough checkup before you buy a high dividend stock. The point which I'm trying to highlight here is that check whether the dividend amount is in line with company's growth. So sometimes what happens is, and again, all these things again boils out to capital allocation, that how you are, and capital allocation is something which I think I have been talking about quite a lot, because all these things boil down to how you can add value from shareholders perspective. So if let's assume that if company is declaring dividend, but then and that is what the next point says, that if a company sees that there are a lot of growth opportunities, either organic or inorganic, but then if a company is paying a dividend, then in that case paying a dividend may not add much value, and in fact it can be again detrimental to the shareholders. That if a company is paying dividend in that case, then maybe what is happening is it is letting off that particular opportunity. So rather than capitalizing on that particular opportunity, the company is just declaring dividends to the shareholders. So again, this may not be a right approach from a shareholders perspective. So, and the last point is that good companies usually maintain a standard payout ratio across all times. So the one of the good things is that, let's say if a company has a history of paying, let's say 60% of its net profit as dividends, so one can be assured that one can be assured that a company might maintain that particular standout ratio, and then that particular stock gets a good value. I mean, the markets respect such sort of stocks where the companies have been throughout consistently maintaining the standard payout ratio. So usually companies have 55 to 60% of their standard payout ratio. But then again, it also depends that if a company has got some good opportunities in terms of organic or inorganic growth, then in that case maybe they can resort to buying, or putting that money, extra free cash flow, back to the business rather than providing dividend to the shareholders. So that was about dividend yields. And again, for a P ratio, a simple way of calculating a dividend yield would be is that, let's say a company paid rupees 30 per share as a dividend for the last year. So again, it's just a hypothetical example which I'm quoting. And again, let's assume that the current market price of that particular share is 1,000 rupees. So the current dividend yield would be 30 rupees divided by 1,000, which is nothing but 3%. So this is what exactly these investors and all. So what they do is, from a macro perspective, that they take the inverse of P ratio, which is nothing but earnings yield, and they also calculate the dividend yield of a particular, and they add it up together. So let's say, if again I'll come back to my Nifty 50 example, that if a Nifty has, let's say, a P of 25, and all the 50 companies joined together, let's say they have a dividend yield of say for example 2%. What will happen is, the inverse of P, which is 25, so inverse of that would be 4%, and then you add 2%, so this is equal to 6%. And this figure of 6%, you compare it with the yield on the 10-year government securities or 30-year government securities. So if, for example, if the yield on 10-year GSEC is, or the government securities is 6%, and even in Nifty 50 also we are getting 6%, then from a rational standpoint, it doesn't make sense to invest in equities, because in equities you have risk, whereas in government securities you have minimal risk. Because you are buying government bonds. So if that is the case, then it will make more sense to invest in debt, or it makes more sense to invest in the 10-year government securities rather than investing your money in equity markets. So this is how the whole the entire things work out in the investment environment. So guys, if you have any doubt related to how to how to interpret all these things, like a P ratio and a dividend yield, or if you have not understood any particular point which I have made it in this particular video, so I'll be happy to help you out, and you can mention your doubts, or any feedback you want to make to this video in the comment section, and I'll be very much happy to help you out in that case. So guys, thank you and have a nice day.